dissecting global macro, well, I think that we have to bear in mind that the global industries, global manufacturing industries will be slowing in the second half of this year. If you look at the two charts on the left, which is the global manufacturing PMI and also services PMI plus the new orders, you can see that the indices are all coming off. However, of course, if you do follow the news quite closely, you realize that China does have some respectable export growth numbers in the last 1 to 2 months. I can say that based on our feedback, basically what the manufacturers on the ground are seeing is increased orders, and what is happening is because a lot of the demand from the US is coming or being brought forward just in case Trump wins and he's going to slap that 60% tariff on the Chinese imports. So there's a good chance that after November, there might be some pullback in the Chinese export and industrial production numbers. And having said that, while the growth is slowing, I think you can see that the commodity prices are starting to pass through to inflation. Although there's some slowdown in inflation numbers in the US that we saw overnight, but I would say that generally inflationary pressure is still there, because if you take the year-on-year growth rate of key commodity prices, that are turning positive on a year-on-year basis, and I do expect that pressure to pass through. And you've already seen that in this month's announcement of Chinese inflation numbers, the decline in the PPI inflation number has actually narrowed. So this is coming through, irrespective of what we see on the US inflation overnight. And at the same time, global liquidity remains quite high. As you can see in the last chart here, the central bank's balance sheets have not really come off that much since the Fed started with the QT. So overall, what I'm trying to say here is that there's still risk that the word stagflation might still reappear in the second half of this year. What about Chinese growth? Is it really stalling? Is it going to resume its growth momentum? Well, I think at this point, it has really stabilized, and there is a risk that it could stall if the Chinese government does not step up on the rescue or the support for the property sector. As you can see in the top right-hand chart here, in terms of retail sales, big ticket items are not really doing well. If you look at the dark dotted line there, which is durable goods, which includes your auto vehicle sales, it has not done well, which means consumers are not really buying your big ticket items. So the smaller ones like foodstuff, your necessities, and your smaller durables are still doing relatively okay. So in a way, Chinese economy, it has stabilized, it has improved somewhat, but to go to the next round of growth, to re-rate further, we need more supportive policies for the economy. Especially if you look at the chart below, the chart below there, which is your investments, private investments, which is the red line. Again, it's just slightly above zero in terms of growth rate. So basically, demand is weak. So, manufacturers are not really investing in upgrading their production lines. So capex is weak. And on the top right-hand chart, you can see production is faster than what the global PMI is showing you. As I mentioned, there's a lot of demand being brought forward just in case the US goes with the 60% tariff. And last of all, the only one that is seeing some narrowing decline is probably property because of the base effect. But as you can see, if you look at all these various segments of the economy, things are just stabilizing, not really picking up in a very big way. So why is this happening despite, you can see on this chart that there has been a lot of supportive policies being announced over the last couple of months or year to date. You had the 50 basis point cut in the triple R, you had increased bond quota, you had some talks about how local government debt will be resolved, you have clash for clunkers, and also encouragement of foreign investments, also a boost to tourism by easier visa requirements. The key point here is really that confidence remains quite weak, and demand for credit has weakened a lot in China. So that is really hampering one part of your policy support, which is monetary easing. So monetary easing is not achieving as much of an impact as it did before. If you look at this slide, the top left-hand chart shows you the red line, the amount of liquidity that has been injected by the PBOC since the reopening is on a cumulative basis. So what the red line shows you that PBOC has been withdrawing some liquidity. Then that seems to be counterintuitive, but if you look at the chart below, the repo rate in China, you can see that's very stable, and it's not at the top end of the channel, which is the red dotted line. It does tell you that there's really no stress in the for funding in the system. So the demand for liquidity isn't that strong. So that's also a reason why you can see that on the lower right hand chart that credit growth has started to weaken. In fact, if you look at the recent monetary numbers that came out of China, right, the net new increase in credit for households is actually negative. So households are still paying down the mortgage, they're not taking on new credit. So in this environment, even if you were to cut the interest rates, inject more liquidity, it's not really going to help because no one wants to borrow. That's why I can find that money supply growth has fallen to below 8%. So how serious is this loss of confidence in terms of deflation risk? Because everybody's talking about deflation in China, about overcapacity and how prices are moving down, right? So I look at the CPI and I look at the various categories. If you look at the top left-hand table, forget about food, which is a major component, but forget about it for now because it's affected by weather. And no matter how affected you are, you still need to eat. But we try to look at other components, right? What is causing this decline in price pressures? The key categories are housing and transportation. And if you look at those two, basically what is driving down prices is car prices is becoming off, competition in the EV space, electric vehicle space, and for housing, it's been house prices. So basically, these are the two key areas that's driving CPI inflation lower in China. In fact, if you look at other categories like apparel, if you look at education, culture, entertainment, spending, the prices in those areas are actually still positive, but they make up a smaller part of your CPI basket. So overall, yes, there is a threat of deflation, but it's really not as widespread as you would think it is. Just because it's a higher weighting in the CPI, it has caused some downside pressure on the inflation numbers. But at this point, I would say it's still pretty much contained in housing and in the auto sector. So because of that deflation threat, because of less effective monetary easing, we really need the government to step up on the fiscal spending. And I've been arguing for a while now that the fiscal impulse is pretty limited because if you look at the top left-hand chart, although you can see that the deficit seems pretty huge, but if you look at the drivers of the deficit, which is the chart below, it's really because the revenue collection has been weaker. It's not that spending has been going up so much. So then where is the problem? Well, first of all, if you look at the table on the top right, if you look at the last row, it seems like land sales, which is a big component of local government revenue, seems to be achieving a lot of completion. Almost 90% of the target for the year has been completed. So the government actually supposed to have the revenue to spend and to drive the economy. But that's not really the case because if you start looking at who is buying the land from the local government, you realize that in year 2023, 41% of the sales is taken up by LGFV, which means that it's a local government financing vehicle which bought the land. Why is it happening? Because you look at 2016, 2017, only about 3 to 5% of land sales is paid for by LGFVs. The key reason here is that there's not a lot of demand for land because developers are not doing well. And when the government does a land auction, in order to prevent the situation where you have a failed auction because there are no bids, they ask the LGFV to bid for it. So it's basically the left hand selling to the right hand. So you can see that in actual fact, local government revenues are actually not doing well. So that comes back to my key point for China is that for the near term, for the economy and for the market sentiment to improve further, for further legs of this market rebound, you really need the government to step up on the support for the property sector, or else it's just not going to look good from here. Momentum might worsen from here. So what about this new productivity growth? Because Xi Jinping has been, have been making this comment about changing the growth model for China, that we should move away from the previous reliance on FAI on property market to drive growth. We need new technology, new productivity to drive growth. So what I did is that here I look at the uh, share of these industries in the overall GDP. So I tried to make some estimation. So if you look at the lower left-hand chart, you can see that if you look combine the share of manufacture of equipment, high-tech manufacturing, and put that as a share of GDP, it comes up to about 12%, right? Quite close to what real estate is contributing, which is about 15. But however, the question here is that if you look at the top right-hand chart, you can see that the growth rate of these two industries are slowing as well. Like I mentioned earlier, private industries are not really upgrading or not really in, increasing on their capex because of poor demand. So this part of the growth is coming off as well. So again, we are seeing that this is going to be good for the economy in the longer term, but again, the short-term contribution is going to be quite limited. All right. So the question is, how serious is the problem with the property market? Are we close to a bottom? What else needs to be done? Right. The question, if you look at the data, right, I think pricing will be the most telling. If you look at the top right-hand chart, you can see that the property prices in the secondary market, if you look at it on a month-on-month basis, which is what we're doing, month-on-month growth, it's still negative. So it's declining, all right? So that's taking out the base effect because we look at month-on-month. And you look at the chart here, the decline is actually bigger than the decline you see in the chart on the lower left-hand on the lower left-hand corner, which is the price dynamics in the uh, primary market. So because secondary market doesn't have government intervention, so it's more revealing in terms of what demand dynamics is, and it's still falling. It's not close to a bottom. So why is it the case? Well, despite all the easing, right? First of all, if you look at housing demand projection, we've done here on slide 14, which is done by my property analyst. I'm trying to get a sense of what the overall market will be like going forward. So what we've done here is that we've taken the projections based on a slower population growth because that's what's happening in China. We've taken the assumption of a lower marriage rate, which is what's happening in China as well, and a lower birth rate. And you can see that what they call the gangshui, which is the uh, owner, home user or homeowner demand, right? You're buying for self-use. That demand is only about 468 million square meters going forward, which you compare for the last decade is about half of that, right? So structurally, demand is coming down. And at this point in time, the inventory, unsold inventory across the nation, if you do not look at what the tiering of the city is, just look at overall inventory, it runs at about 25 to 30 months of sales, depending on what your growth assumption for sales is for this year. So the magnitude of the problem is really huge. So how much change would this 300 billion RMB for destocking would do for the overall picture? Well, 300 billion RMB, if you take that into the banking system, you leverage up and use that money to buy inventory off the market, it can account for about 2% of last year's sales, right? That's not a lot, right? So no more needs to be done. If you look at the destocking program they did before, they did about 5% of annual sales. And if you use 5% of annual sales as a benchmark, then you need about 750 billion on average, or they come up to about 1 trillion as well. So this is the money that we need, and we need to run this for the next few years. So this is why I mentioned that everybody, including other institutional investors, we're all looking at how much more money the government will put into this program, right? So my concern is that if you look into the announcement of that program, they basically say that the SOE developers which have been identified to participate in the program, the banks which are going to participate in the program, and the local governments are all supposed to negotiate or discuss on the scale of the rescue effort. And then they are supposed to discuss or negotiate with the private developers on the pricing of all those assets that they do intend to buy over. So that means that a lot of things are up for negotiation, and it could mean that we might not have any results anytime soon. So in the best case scenario, we are assuming that the government is putting up 300 billion, look for a few test cases, cases see that there's success, and then they'll put in more money, right? But if they don't have enough, achieve enough between the announcement and the July third plenum, there might not be any announcements of further cash injection, right? So this is our concern here, and this is so why no, we are telling investors that you might want to book some profit now ahead of the third plenum. So the next part that is important for China, apart from the housing market, is really labor, because people might also want to buy a house if they have job security, right? That's the other part of the equation, not just about house pricing, but also about the job security. Here you can see that the data is quite consistent with what we see in China recently about travel, about consumption habits, is that if you look at the underground ridership, which is the top left-hand chart, it has improved. If you do recall, beginning of the year, there were some concerns about economic activity in China because underground ridership in the key cities were lower than what we saw in the same time last year. But if you look at the year-to-date ridership, it has improved dramatically. So people are out, people are traveling, people are eating out, dining out, but per capita spending is lower. So people are doing things on a shoestring. So that's what's happening, right? On average, if you look at the labor market, if you look at the chart on the right-hand side, the index of manufacturing prosperity, that has improved. That's almost like a diffusion index. It's like above 50% means improvement. And this is the data that's compiled by Shanghai University, 交通大学, and then they did a survey together with an online employment agency. Right together, they collate the data, and they showed that for the past few months or since the reopening, the labor market has been improving gradually, and this is positive. This is something that we should be happy about, right? And the next thing, if you look at the weekly average hours worked, that's also improved. Although you can see that there is some decline recently, but by and large, we are much higher than the pre-opening levels. So I would say that if you look at this, the labor market in China has stabilized and is gradually improving. So that's why I'm quite hopeful that if they are able to step up on the rescue of the property market, improve on the economic confidence, the Chinese economy and the Chinese stock market can actually take the next leg of the rally or next leg of the improvement. So again, focus on what they will do for the property market in the coming months. And okay, so why am I concerned about fourth quarter? Well, one thing is the trade war, right? You know that the U.S. will have the presidential elections in November, and Trump has already threatened to hit China with a 60% tariff across all products. And during the first phase of the trade war, or during the initial trade war in 2017, 2018, right, China had a trade deal with the US. They call it a phase one trade deal. And if you recall, China did not fulfill all the requirements, right? They just stopped buying the American goods to the extent that they promised. So if Trump is going to come back into power, he will probably want to hit China with another trade war because he wants to win. That's him, right? So he would take that 60% threat, 60% tariff threat on China, although it will mean quite a bit of inflationary pressure on the US, but he will use it as a threat to negotiate for a better deal for the US and force China to finally fulfill their requirements. And this will be a serious impact on China if it does try to hit China with much higher tariff, because the last round of the trade war saw the tariff on Chinese goods in the US rise from 2.7% to 12.5%, and 60% tariff will be 4 times more, right? So the impact on Chinese growth will be quite significant. And even if he doesn't put it in place, he just use it as a negotiation while that is happening, taking place before a deal is being struck, I think markets will sell down, right? So Chinese equities will be hit. So this is something that you have to bear in mind. So as a whole, I'm not going to be aggressive on the Chinese growth numbers because 4.5 to 5% kind of GDP growth level, it will be the medium-term growth level for China, potential growth rate given the declining population and the falling investment. So this is the base case. Where I do differ from the market, I think I do expect much more money printing to come. So my forecast for money supply is higher, and my forecast for a yuan is slightly weaker, but no big declines because on a trade weighted basis, the yuan is still quite stable because the yen has fallen a lot more. So despite a lot of the negative press, China gets on the slight yuan depreciation, it hasn't fallen a lot, and China does really have the capacity to print money and allow the property market to recover. So this is something that can be done. It's just whether they want to do it. Okay. So how else we approach the market, the strategy? I think there's one other thing I want to highlight to you is that, the recovery in the Chinese equity since March wasn't really just about policy clarity. Of course, that's one big thing. But if you recall, during the two sessions in March, the Chinese government in the press release did highlight that one of the issues they identify or they recognize is that communication can be improved. They realized that different government departments were announcing policies that were contradictory, and investors were confused, and they will seek to improve on that in the coming months, which they did, right? And so the market actually improved, or the sentiment improved on the back of that, and the market rallied. But the other part of it, which is driving that rally, is liquidity, right? So if you look at the mutual funds industries in the US, one of the things that's been driving these fund flows back into the emerging market is what's happening in the US. Because if you look at the top left-hand corner chart, the dotted gray line shows you the exposure to equities. And that has come up to a very high level. And this chart goes back to year 2000. So what happens when that happens, especially at the time, if you look at the chart below, when cash ratio within these funds are low, what do the fund managers do? They allocate more of the funds into other emerging markets in search of higher return. And so you can see that at the same time, the emerging markets start to break out of the resistance, and China, being one of the cheaper markets, actually broke out of the downtrend as well. So this is helping to drive it. So there are two parts of it, right? Liquidity inflow back into emerging markets and better policy communication in China. And you can see that because of this funds flow in search of high yield, you can see that Chinese US dollar high yield bond spread has also narrowed, right? For a time, the spread was really high because people worry about default by Chinese developers. But again, after the in search of high bond yield, it's narrowed, right? So again, so what should we be aware of going forward is really the US 10-year bond yield, right? If that starts spiking up, I think no matter what China does on this policy, the overall upside could be kept as well. So this is something that you need to bear in mind. So what is our target level for the second half of this year? Well, I've started the year. I think the last time I spoke to you, my target was 11.5 times 12-month forward PE. This is the chart I've been using. And I think that the upside will still be 11.5 times because with 4 to 6% real GDP growth or 5 to 7% nominal growth, EPS growth coming in at low teens, about 10 to 13%. If you apply a 1 times PAC ratio, the PEG is about 11 to 12 times. So I think this is a level that the market could potentially re-rate to. What does it translate to the HSI? At 11.5 times for the MSCI China, and the equivalent upside will bring the HSI to about 22,000. That's what we're looking at. All right. So if we see that level, I would really encourage you to sell into strength. And what are sectors then that we should be more comfortable with? Well, if you look at the earnings forecast by the street, by all the sell-side analysts, this table shows you that if you look at the second column from the right, it shows you that the earnings changes since the start of the earnings season. All right, so pricing in management guidance, pricing in the results. So we can see the consumer discretionary has been doing much better than other sectors. If you look in the details, it basically came from the fact that earlier forecasts for the ICE car manufacturers, the OEM, the original, like the traditional car manufacturers, were too bearish. They got upgraded. Sportswear, the outlook improved because inventory reduction has been done. And if you look at the TMT names, you also realize that the advertising revenue has improved. So overall, consumer discretionary sector has been doing well. There are sectors that did well were commodities and energy, materials and energy, but that's more internationally driven. So within the domestic sectors, consumer discretionary should be something that should be more resilient going forward. So I want to jump to this chart then, overall strategy. So what do we buy, right? Again, I did mention that earlier, but I just want to reiterate that we want to be focused on more domestic focused name because I'm worried about the sanctions from the US that might affect the export dependent sector. But within the domestic industry, where there are policy support, will be on your AI automation, um, your new materials, things like that. But on consumption side, you're really going to be looking at small ticket consumption because, as I did explain, while the labor market has stabilized and showing some slight improvement, we are not at the level where consumers are really spending on big ticket items. So they're still going for value for money. All right. And for the financials, I think there will be more triple R cards that will benefit the some of the banks because they will allow them to lend more money. I would avoid the big four because there could be a risk of sanctions by US, but I think China Merchants Bank is pretty safe. And for the tech AI, handset component is more a play on the global cycle. So this is what I'll be focusing on. And property, we do expect that the government will put in more money. That's our base case assumption. And to play on that, I'm actually putting in a property broker because I think that could be a high bidder play of any recovery in transaction. So overall, if you look at the key names that we are recommending on this round, we are looking at Tencent, and for autos, we are looking at Geely. The reason why we are Geely and not BYD, although BYD has many models, they have 30 EV models now, introducing another 10 this year. But it's more the relative dynamics because these traditional car manufacturers are coming in with EV models. Geely had 6 last year. They're introducing another 6 this year. So it's a 100% increase. So the contribution to the top line revenue growth, the sensitivity is a lot higher. So given the valuations, we prefer to buy into the traditional names that's increasing the EV presence. And if you're looking further down the line, on the Chinese property broker, I recommended KE Holdings, which is Baker, right? Our assumption here is that the easing of the mortgage restrictions, easing of the purchase restrictions should encourage more transactions, and that will be a key beneficiary. Further down the line, I have Hong Kong Exchange. We have not talked a lot about this name, but given the recent increase in transaction volume, and also something that we don't put in the research, but something that is worth considering is that um, Hong Kong, if you recall, just passed the national security law this year. And if you recall, in previous years when Macau passed the national security laws as well, central government actually gave Macau quite a lot of support on the tourism and the likes, a lot of goodies, right? So for Hong Kong, financials is a key industry, and the government has already indicated after the national security law was passed, there was news flow about, for example, removing dividend tax on dividend payment, increasing the scope of assets suitable for the stock connect, encouraging more Chinese companies to come to Hong Kong to do IPO. So these are things that has been talked about. The market has run up a little bit on it and taken profit, but I believe that key dates coming up like 1st July handover anniversary and also 1st October, the National Day, could be key dates where the government could put in further positive news flow for this stock, and Hong Kong Exchange will be a key beneficiary. Right. So further down the line, the last 3 names, ASMPT, Foxconn, and also Lenovo, basically is within our coverage. Names we think will benefit from the increased server demand due to the growth of the AI industry. All right, so I'll not go through everything, but I'll stop here. I'll leave some time for questions from you. Okay, so let me know. So any questions on the presentation, or you have other things that you might want to know? So I think in this marketing, generally, what institutional investors are looking at is, as I mentioned, they were asking about, what is the view on the property market. I think the other one they did ask about, what about insurance? Why are we not looking at any insurance names? And aren't they going to benefit with any improvement? I think on the insurance side, our view is that we're concerned about the investment returns, given that China has been cutting interest rates. And the other concern we have is that the number of agents in China is falling, declining. It's not going to return to previous levels, so that could affect the growth of their new business in China. And for the regional names, I think AIA has recently not met its guided investment returns. So that is the key concerns why we do not have insurance names on our recommendation. Um, okay, so there's been question. So I think that pretty much answers the question about Ping An. So generally, we don't really like insurance names at this point in time. So for the property names, the developers, if you're not keen on Chinese on the broker, I would generally prefer the privately owned developers. Our pick is who, right? So, but however, we've sensed that the uh, share prices of developers have been quite volatile due depending on news flow, and investors tend to take profit quite quickly. That's the reason why we did not put in a developer name. But I would think that given the dynamics of the industry, I would think there'll be more upside for a privately owned developer than the SOE. For SOE developer, our key recommendation is still Coley. Okay, so let me see what other questions there are. Okay, why is Haidilao doing better than Jumaoju? I think Jumaoju recently, I think in general, right, the F&B outlets, even if you look at the Yums China, they're also talking about having to cut ASPs because consumers are actually, again, looking for value for money. So Jumaoju also saw that, they had to cut prices, and because of competition, promotion, advertising are also more costly at this point. But why is Haidilao doing better? I think it's because of they did so badly before, and due to the restructuring of their businesses, they're able to move into better locations, and also they're coming out from a low base in a way. So that's why the short term dynamics Haidilao is actually doing better. But if you look at the longer term, I think that you still need to be mindful of the fact that competition is still quite steep. But at this point, we think there's still more upside to the F&B industries, and Haidilao is actually our pick. But Jumaoji is really that the promotion expense and the need to cut ASPs is actually affecting them at this point. What about outlook of Alibaba and JD? I think for Alibaba, there's a short-term opportunity. I think a lot of investors are looking for the upside from the stock being included in the Stock Connect. So Southbound investors will be buying because they can't buy currently. And so far, if you look at Southbound flow into Hong Kong, they usually focus on names that they don't have representation in China, like basically say 没有标的, right? So if I want a big TMT name, I have to go to Hong Kong, and now Baba is actually available. So most brokers are, and also investors are looking at that as a short-term trade. But my concern about Baba is that they have been doing a lot in terms of trying to unlock values in their business. But it basically is very reflective of the founding partners taking cash out, of China. If you look at Baba, they really haven't had any new businesses over the last 2 years, I would say. Compared to Tencent or other businesses that they're actually building new growth drivers, but not Baba. Right, so that's my key concern about Baba in terms of the overall outlook. And some people did mention, well, what about the cloud? They have the cloud computing part. But if you look at recently, that because of competition, Baba has been cutting the cloud computing prices, the fees, and most recently, the competitor actually went to even reduce some of the cloud pricing to free just to compete and capture market share. So overall, I'm not really keen on Baba as a business, but if you want to go for a short-term trade for the software inclusion, I think that's fine. JD, I think it basically is still affected by the fact that consumers are still focusing on value for money, and JD actually has been investing more in this space. So if you want to look for a de facto name to look at for e-commerce, I still think PDD will still do well and outperform JD. All right. If you look at the okay, sorry, just a minute. Let me look at other questions. Uh, okay, there's no company in China that can now step up to potentially become a challenger for Nvidia. Really, no, not at all. Yeah, not from what we can see. What is the typical market P for Hong Kong and China domestic stocks? Well, I haven't looked at it that way to different sectors, but if you look at the broader market before this recent run up, it was trading about 8.5 to 9 times. I think that was the kind of range that investors were comfortable with when they were concerned about the growth outlook for Chinese equities. So we could potentially trade back down to that range if the Chinese government does not deliver more support for the property market. So that is my one of my points on this presentation. All right. Okay, for the banks, I mean, I do have a recommendation on China merchants because I think that they can be quite defensive. They do have reasonable dividend yield, and the triple R cut would be positive for them as it release more funds for them to be able to lend. But as I did say, be careful of the uh, potential U.S. sanctions on the Chinese banks for perceived Chinese support for Russia. I think some clients did ask about, can this dividend yield from Chinese banks be sustainable? Can we trust the quality of the assets? I mean, I personally had that question before or had a concern before, but if you step back and think about it, as long as the Chinese government does not uh, request that the banks uh, define certain kind of loans as non-performing and make provisions for that, they don't have to do it, right? Um, um, the only differential between now the bigger banks, SOE banks versus the China Merchants Bank and the likes is that the bigger banks they actually have to raise more capital because they're systematically important bank. So that's also another reason why you need to stay away from the bigger banks. But CM Bank is fine. So be selective in the financial space. Okay. Uh, okay. Yes. Sorry, let me go through the and see what I can actually comment on. Uh, okay, for the Hong Kong property side, I wouldn't recommend the developers at this point because I think there'll be more downside pressure on the Hong Kong property, especially given that the uh, interest rates, right? The Fed, of course, last night markets are pricing in 1 or 2 rate cuts, but by and large, I think that the decline in the benchmark interest rate is going to be slower than previously expected. And of course, if you look at the Hong Kong property market, near-term supply is going to be quite strong because a lot of developers are trying to complete the project and sell. That has led to a imbalance. So I'm not keen on developers at this point. For Link Rate, I think you can buy on this dip because near-term sentiment has been affected by the talk about Hong Kong people moving over to Shenzhen to spend on the weekend, like Singaporeans like going to Johor. These guys are just going to Shenzhen to spend. And if you look at the retail scene in Hong Kong now, it's pretty quiet. and the Chinese visitors who come to Hong Kong don't really spend money. So retail sales data is pretty weak. But if you look at Linkread, we had spoken to the management recently. They did mention that the impact on their rental reversion cycle is not huge, and they will be able to keep up with their the payout. So that's why I think that it's good to buy Linkread at this point. For Hang Lung, for the office space, again, um, not very good commercial office space because of the high vacancy. I think outlook-wise, if you compare the three segments, Linkread will be the better name to look at. Okay. Mm. Why do we not consider BYD? Well, BYD, I think, is, as I mentioned earlier, we're just looking at relative dynamics, right? BYD are not going to see as much growth in introduction of new models this year, whereas Geely is going to have a good, in terms of growth rate, a good uh, number of new models. On a year-on-year basis, seems like 100% increase in new models. So we're looking at relative dynamics, Geely coming from a low base, and attractive valuation. That's the reason. But on the whole, we are actually quite negative on the EV space because of price competition. So of course, recently, we had news about the EU imposing tariff on the Chinese producers, but actually that's not going to be very significant for the overall industry, because if you look at the Chinese EV manufacturers, although the EU account for about 34% of EV exports in the first quarter of this year, EV exports is only 7% of total EV sales for China. So EU demand is only 2.3% of total EV sales for Chinese names. So just want to let you know where we stand on this. Well, it's not good news, but it's not going to be a very big impact either. Okay. Okay, let me see. I think generally on the semiconductor space, I wouldn't recommend Chinese semiconductor at this point. I think there has been around the share price recently because the government introduced another 47 billion. But I still see, from what we hear, what we read, that the technology is really not there yet. And there was some market talk, I'm not sure, I cannot verify, right, that the Chinese have given up on the 7 nano, because the last time Huawei claimed that they did 7 nano, they say that it was some method that they use that's quite similar to 7 nano. But recently there's some market talk that they are having issues with 7 nano. So given that, I don't think it's a good time to put in money in the Chinese semiconductor space. US, okay. Pharma names, I don't really recommend pharma names at this point. Main reason is that the domestic-oriented names will continue to be affected by uh, they call Jitai, right? The government will still do that and introduce price cuts, so your margins will be affected, and then the externally exposed name will be hit by the U.S. sanctions time and again. So it's just not worth your time looking at the pharma names in China. So yeah, nothing from me on that end. Baijiu sector, well, you can see that recently the wholesale prices for some of the Baijiu is still coming off. I would say that if I were to look at the relative if I were to look at the beverage names, should I buy beer or should I buy baijiu? Beer also suffered because recent bad weather in China. In the south, it has been rainy for the past more than 1 month. That has affected the overall sales, but I will say that I'll put more of my money in beer because at the end of the day, it's a small ticket consumption. So I will think that the premiumization effort will continue to pay off in the near future as well. Post this slight weakness due to the weather conditions. So within beer, our pick is CR beer. Yeah, that's our call. Okay, I think I by and large answered most of the questions. Okay, so yeah, I think there's quite questions about Hong Kong REITs. Like I say, I like Link REIT at this point, but generally the other REITs which are more exposed to the office space, I just really don't touch because the vacancy rate is really high, really high. Okay. Um, I think for EVs, we have some prospects. Well, there's just a lot of competition in EV now. Of course, China is still a leading player with the key technology on the EV, but you can see that EV adoption is starting to slow in many developed markets. So, and I think that China might also see this issue because one of the things that we have not resolved is really the performance of the batteries. And you can see that during the cold weather, during Chinese New Year, when they travel back to their hometown, a lot of people had to just abandon their car on the highway due to the bad weather, and they just got stuck in traffic and just run out of power. So I think that kind of it does reflect, although you can say it's sensationalizing the kind of issues, but it does in general shows you that the overall infrastructure for supporting EV is still not there, not even in China in terms of the charging capacity. So one of the things that could continue to pay off in the future when you look at EV is really exposure to the EV charging infrastructure. It's something that we haven't really looked at this point, but I think it will be meaningful. So, but I do think that in the near term, there's a risk that EV adoption rate will start to slow. In any case, in China, the EV penetration rate is really quite high. Right, in terms of new sales, they're already running at more than 50%. So that's also something you have to consider that going forward, the growth rate it will start to slow and competition would remain very intense. Yeah. Okay, I think. Yeah.
Okay, thank you, Man Hong, for this insightful presentation. For more upcoming webinars, please visit utrade.com.sg. Once again, thank you for joining us and enjoy the rest of your evening.